All right, I got good to go? Yeah, okay. Hey everybody, I'm David, here to talk about raising money from venture capitalists, but sort of investment in general. 5 types of game funding that I've seen. Publisher funding, which is a pretty common form of funding. Debt financing, where somebody lends you some money at an interest rate. Grant funding, you're doing something that people like and want to give you money to do it. Kickstarter, everybody knows, and equity financing. And it's this last one that I want to talk about today. So my background in the games industry is sort of 30 years of asking people for money in one form or another to make games. So 10 years at publishers, mostly EA, and that was an internal process. So I'd be saying, hey, Greenlight team, please can I use an internal team to make this Mega Drive game? That was when I was there. And of course, I'm not directly asking for money, but there's salaries to be paid, and that's how that works internally. And then 10 years of project funding. I ran a company called Relentless here in Brighton that made some games for Sony. Hey, Sony, will you sign this PlayStation 2 game that cost $5 million to make? And I think this has probably moved on a bit, but my experience with this was that you would ask for $5 million and about $1 million of that would be contingency or profit. And maybe you see something on the back end. And that's my experience of sort of project funding. And then the last 10 years have been equity financing. Hey, VC, please will you invest $5 million in exchange for 15% of the company? So 3 different things that I've done, 3 different ways of raising money, or at least getting things going in one form or another. And one thing I've noticed is that in the UK, for reasons I don't really understand, the predominant model seems to be the middle one here, or at least if you're running an external company where you're going and asking a publisher for some money or somebody in order to fund that project, not equity financing. And if you go to an event like Slush, which is a sort of mobile-centric event that happens in Helsinki, then I would say that 9 out of 10 of the deals going on are equity financing. And I'm not quite sure how this came about, or at least my impression is that majority of funding here in the UK is project funding, but elsewhere in the world, whether it's California or the Nordics, seems to be equity financing. And so all I want to do today really is describe, and help share some information that I found in the last 10 years of doing this. Trust me, I'm a developer. By that, what I mean is I've seen, maybe you've seen, VCs stand up here and talk about how it all works. And to me, there's too much bullshit. There's too much polish. You never really get to the meat of it. And so I'm sort of want to do the warts and all version. So no bullshit. And you can ask me anything. And I'm going to try and be really candid about all my experiences and all the numbers so that you can get a sense of how that works. A caveat is it's only my experience. Like I've done this for a while, that form of funding, but your mileage may vary. And I've never worked at a VC, so I talk with them a lot and I like them. But I don't speak for the VC industry. But the point I'm trying to say is I'm coming as a developer rather than as somebody that invests. Some headline stats. These aren't great stats actually, but we'll dig into it. Billions are invested in games companies every year in equity financing across hundreds of deals from hundreds of VC firms. Now, that last point, when I started doing this 10 years ago, and I go and speak to venture capitalists, there was like 3 or 4 in the UK that I could speak to, maybe 7 or 8 in Europe. And it's quite scary because if you'd spoken to all of them, then it's not clear what you do if you run out of people to speak to. There are hundreds. Like I've spoken to 200 VCs in the last year. So that's something that's really changed in the last 10 years of my experience. These are some numbers that I pulled out of a report this morning. So I've got a link to it at the end. And I can't vouch for the quality of this information. It came from a report from a company called InvestGame. But the bit I've circled there is that early stage deals, like when you're starting a company, deal activity remained resilient in 2022 with nearly $1 billion invested across 109 deals. So there's like a lot of money going into it from venture capitalists, and you can see how that varies over time. And here's it's not a secret about where the money's coming from. This is a list of who's doing the deals. So you can see Makers at the top with 14 deals with about $500 million worth of investments. And sort of list, but this list goes on for a while. And also this point here, which is the VCs deploy money from funds, and as per this statement here, there's just a ton of money sitting in funds ready to be deployed into the games industry. So, you know, they're saying that about, you can see Griffin at the top there has raised $1 billion in their fund to be deployed exclusively in games. And you can see a sort of list of some big numbers there. So there is money to be invested in games, and their job is to invest it in games. They don't get paid unless they invest it in games, they cease to exist. So, you know, it's good to sort of break that master and servant dynamic where you're thinking, please, can I have some money? The reality is they have to spend the money in order to continue to exist. And there is, you know, a lot of money there. So let's imagine that you have a company, this I think everybody knows, but I'm going to do it anyway. Imagine that you have a company that you say is a valuation, you're saying it's worth $20 million, and you need some investment from a venture capitalist, and they give you $1 million. Then they end up with 5% of the company. And then sometime later, there's an exit. By that I mean either an IPO or more likely a sale of some kind. Imagine that's a $200 million sale at that point. Then obviously the fund get their $10 million out. So they've done a sort of 10x, put $1 million in, got $10 million out. And I guess that's pretty obvious. I guess the one thing that wasn't clear to me is that there's no concept from the VC of taking money out at any point in between. So even if you have a mega hit game and the company makes loads of money, no money ever goes to the VC until the company is sold. And with that in mind, you know, there's two sides to that, I suppose, which is that they'll only give you money if they think you're going to sell at some point, because that's the only point at which they make money. So imagine there's a $100 million fund in a VC, and I've seen sort of funds range from about $30 million to about $1 billion. Those are sort of ranges. And in a $30 million fund, they're giving out checks of $100,000. And in a $1 billion fund, they're giving out checks of, I don't know, 10 million, 20 million, $50 million. And I mean, it's obvious, I suppose, but they'd be too busy if it was a fund, a $1 billion fund giving $100,000 checks out, then they'd be giving out checks. It's just too much work. So the size of the fund dictates the size of the checks. So imagine a $100 million fund. The money comes from what are called limited partners, LPs, and that could be high net worth individuals, the very rich people or family offices. It could be institutional investors like pensions or endowments that are sitting on a lot of money and are trying to decide where they can get a good return. It could be strategics, and this was something that was a surprise to me, that strategics means people that are maybe already in the industry. So for instance, Square Enix invest a lot in venture capitalist funds that then in turn invest in startups. So Sega and Square Enix and plenty of other companies that you know are investing in startup companies, games companies, but they're doing it through VCs. And fund of funds. So these are very big VCs that instead of putting money directly into companies, they put money into funds that in turn put it into companies. And the money goes to, well, let's say that this $100 million fund, by way of example, it'll be a little bit different from fund to fund. But imagine there's 25 companies that invest in at an average of $4 million each, and they do about 5 per year. So this $100 million fund gets deployed over a period of 5 years. And, you know, you can work out that's like, what did I just say? Yeah, five per year, thereabouts. And then, so that's what they call the deployment phase, that first 5 years. And then you have the harvest phase. Oh, no, hang on, wait a second. They also set aside some money for what's called follow-on. You don't want a situation where you've invested in a company, the company needs more money, but you're not in a position to help that company out because all the money's gone, you've used the funds. So they always have this concept of 50% being held back for follow-on investments. And then at the very end is where they make their money, or at least one place where they make their money. So 2% of those goes to fees. So of that $100 million, 2% of it goes to the people running the fund. And then the other place that they make their money is 20% of the profit, i.e. if above, at the end of that period, goes to the fund as well. And let's break that. Yeah. So imagine that sometime later, that fund is now worth $200 million. And that's about right. I must admit, I sort of, even like last week until I started researching this, assumed that, money makes money and people put money into these VCs and they got 10 times out. The reality is that often it doesn't outperform the stock market over that 5-year period. And maybe doubling your money over that 5-year period is a good result. So it's not like a guaranteed way of making money by any means. So in my example here, imagine that this $100 million fund, 5 years later, I should have explained that they have 5 years deploying the capital, which is, and then 5 years harvesting the capital. Not a particularly nice word, but so they have sort of 2 phases, deploy and harvest. So imagine at the end of that period now, sort of 5-10 years later, where they're getting the return. And in this case, there's a $200 million return, which is obviously a $100 million profit. And here's how that typically breaks down. So imagine those companies that they put those investments into, 50% of them fail, 30% of them break even, like you put 4 million in, you get 4 million back, so just break even. 15% return the fund and 5% create the profit. So let's, I'll try and put this into a diagram. 50% of them fail, so they just don't appear in that $200 million return. But then 30% break even, they just return the money that was put into them, so sort of neutral. When I say 15% return the fund, what I mean to say is that 15% are compensating for they've made a profit, but they compensate for the fact that 50% of the companies they invested in have died. And then at the end, there's like an investment that makes all the profit for the fund, and that's quite typical. And that's a sort of scary thought that that rocket there, and that probably one company in this fund, they put in $4 million and they've got $100 million out. So it's a 25 times return. And I was speaking to, when I was doing these slides, I was speaking to a friend who's a VC and saying, oh, you look for 10 times return. He said, no, David, there's no way we would invest in something if we thought it would only give us a 10 times return, which is like, what? But the point is that one of these companies needs to create the profit for the whole fund. And it means that if you go in there saying, we're going to 10 times our money, then you're not going to get the investment from the VC, which is sort of outrageous, but that's sort of how it works. And of course, the vast majority do not become these billion-dollar companies, but VCs will only invest in companies that have the chance of being that, or at least as is my experience. I talked about sort of how VCs work. I think it might be useful to talk a little bit about how you start a company, how you get out the gates. And again, sort of talking about things that I've done in the past. One way of doing it is to bootstrap your evenings and weekends and just trying to get a prototype together, get a team together, try and make something without actually taking any investment. That's called being bootstrapped. Another one is incubators and accelerators. I'm not an expert on this, but I think it's sort of working with a company that help you find investors, find co-founders, improve your deck, just make sure you're investor ready. I think that's by and large what they offer. Another one is angels, so that's one that we used where I speak for the UK. It feels like there's about 50 or 100 angel investors in the UK that will invest in the games industry, putting in checks between £10,000 and £100,000 maybe, and they like to get in early, and they care a lot about deal flow. So their job is to listen out for opportunities of things to invest in the games industry, try and get there early before the venture capitalists. So again, I want to break that sort of master and servant dynamic of like, please can I have some money, angels? No, the point is they want to hear about these deals because they want to get in early at a lower valuation. And also some of you will know that there's a way of constructing your company that makes it very tax efficient, particularly for UK investors with SEIS and EIS. So, and often in my experience of angels is that one angel, influential angel, will say, all right, yeah, this seems interesting, I'm going to do this, and then will tell his other friends that, hey, let's do this too. And often it's people that are already working in the games industry, have had some success, and it's maybe people you know or know of at least. So that's most of the time I'm seeing angels as being people that have already had some commercial success in the games industry and are looking to sort of do something interesting with their money that's familiar to them. So that's, I think, typical ways of getting out the gates. So I talk a little bit about how over the period of time of running a company, those phases, investment phases, let's say, and one by one. So first, and again, this is my experience, actually the next slide talks about exactly what we did with my most recent company. So first of all, there's a pre-seed stage of, I don't know if you can see it, like $100,000 to $1 million. And this might come from angels that I just mentioned, smaller VCs. So if it's a $30 million fund, then in the habit of cutting, $100,000 checks, then maybe that's a place where you get investment. And at that point, it's really a founder and a deck, maybe a prototype, but you don't have to have the world on the stick at that point. Your valuation is lower, and it's an opportunity for angels and other people to get in early. So that's sort of what's expected at that point in pre-seed. So next, as you might imagine, is seed funding, ranging, again, in my experience, between about $1 million and $5 million. And it's all in dollars, by the way, because that's sort of the international currency. It's not particularly UK-centric thing, so everybody around the world just standardizes on dollars. That's why I'm using that. Anyway, $1 to $5 million comes from VCs, and I think at that point you want to show that you've got the team hired, maybe you've got a prototype, it's starting to get a bit of traction. And then sometimes there's a seed extension or pre-series A, you might call it, which is, maybe you're not profitable at that point, but you do need more money in order to keep the company going. But you can show progress and maybe even some KPIs, but you're not at a point where you're cash flow positive, and therefore you're still relying on investment. Not always, but that's a thing that I see and it's fairly common. Same sort of amount of money. And finally, the Series A, which, I don't know, it starts to get outside of my field of understanding, truthfully. But, I think typically between $10 and $20 million coming from larger venture capitalists. And at that point, I think you want to prove, hey, I've got something here that if you put $1 in, then $2 come out. So can you give us a lot of money so that we can feed the machine? But at that point, I think you really need to have something, or typically you need to have something that is ready to scale. So my most recent company is a company called Playment here in Brighton. And so I'll give you the sort of real numbers here. So we did a pre-seed investment, and we did $600,000 of investment from 10 venture capitalists, all giving us, 10 angel investors, giving us $60,000 each, all people from the UK. That was at a $5 million valuation for the company. And at that point, we had the founding team, and we had a deck of what we planned to do. Then we did a seed round at the beginning of last year. That was a $4 million seed round at a $26 million valuation. That came from 5 venture capitalists, and they're sort of international venture capitalists. There's nothing, people that we liked, felt we had a good relationship with. And at that point, we had the team hired, at least the majority of, and we had an early prototype. Then, we're still not profitable. So as I mentioned, we did an extension. This was just before Christmas, another $4 million at a slightly increased valuation, a $30 million valuation. And at that point, we got a proof of concept, and we shipped something, and we got visible progress on the next game. And that's sort of where we are now. And then, Series A is probably somewhere ahead of us. I think we'll probably end up having to do that bigger investment round at some point in the future. And maybe what have I said there? I don't know what the valuation is because I haven't got there, but TBD. How valuations work, and this is, I talked about the fact that our seed round was a $26 million valuation, and or even prior to that, how do I tell a bunch of angel investors that my company, there's nothing more than 3 people in a PowerPoint deck, is worth $5 million? It doesn't make any sense. So how valuations work is, to me, a little counterintuitive, but sort of works if you think about it. So I always think that you need to raise enough money to get to that next stage. I talked about that on a previous slide. And you're saying we need enough money to get to proof of concept or whatever it is. And that's the amount of money that you need to raise. You know that. You probably you don't want to raise 3 months worth of money because otherwise you're always trying to invest. So maybe that's 6 months, 9 months, something like that. In exchange for about 15% equity. And this is the weird thing that I hadn't realized, which is that if a VC says, yeah, I want to have 50% of the company, please. That's not going to work. My understanding is that used to happen where VCs would try and take as much as they can of the company, but that just causes a problem further down the line. Like you've taken too much, and now if you have to raise again, then where's that money coming from? The founders give, it doesn't work. So they sort of settled on this number where at each stage, when you go and do it around, it's always about 15%. So you're raising whatever you need to get to the next stage in exchange for about 15% of the company, which dictates the valuation. So you can do a bit of maths, like this is sort of what we did. So imagine you need $600,000 to get to the next stage for 15%. And then, there's the maths that takes you to a $4 million valuation. So to me, it's upside down, but by and large, that's how it works. Alternatively, and also, is there talent scarcity? These things really affect the valuation of the company as well. So is there talent scarcity or talent abundance? Like if you're pitching, if you just finished work at OpenAI and you're setting up a startup, holy moly, your valuation is going to be fine. Don't worry about it, whatever, anything else. However, if you're trying to make a mobile game right now, there's an abundance of talent of people trying to do that. And so that very much affects the valuation, as you might imagine. Capital scarcity or capital abundance. Like sometimes there's lots of money to invest in games, sometimes there's less. And that will be down to how people feel about the games industry or macroeconomics. Right now, if you're that endowment fund, then maybe the best thing to do is put it in a bank where you get 5% interest, not risk it in a venture capitalist fund. So sometimes there's a lot of money available and sometimes there's not, for all sorts of reasons. One thing that certainly has an effect is who's leading around. So there's a concept of a venture capitalist. As I said, we have 5 and our Bitcraft led our round. And Bitcraft, by way of example, is a venture capitalist that, it's quite credible. So they sort of vouch for this playment company, have they? And then that has an effect on whether or not other people want to invest. It's sort of social proof or something. So who's leading the round from a venture capitalist point of view is important. And also is their term sheet. It's at this point, you're sort of working into FOMO a little bit, like, hang on a minute, are we losing the opportunity? It's strange, like you can have exactly the same company with exactly the same KPIs, but how people treat it and what the valuation is very much depends on human factors like these last two. Like, is this a deal that's about to get away from us and should we act? So a combination of those two, last slide and this one, maybe. Who gets funded? I talked about this a little bit. In terms of which companies get funded, you would have heard this before. The founding team, VCs always say that, it's completely true. But specifically what they look for is, have the founders exited a business before? Have they, that's a big tick. If somebody's already sold a company in the past and they know how to do it, they're geared that way, it very much reduces the risk. Have the founders work somewhere cool? That's a better way of putting that bullet point. But if you worked at a glamorous company that's done interesting things, then that's certainly another tick. But also, okay, you work there, but if you also had a relevant position, like did you actually contribute to the success of that thing? So they're looking at those 3 founders or whatever it is and seeing what have they done before. So in our case, I exited a business in the past, and our CEO was from Epic, and Mediatonic worked from Fall Guys, and our CTO was from Unity. Tick, tick, tick. That's the first slide they go to. And my understanding is, certainly with a lot of VCs, it's pretty barbaric. They'll just go to the founding team slide, and if it's a no there, then it just goes in the bin, and that's it. So it's pretty brutal on that first point. That's like the most important thing. The next is the thesis, comes after the founding team. Like, what are you actually planning on doing? Like, what is this? Why is this? Why are we doing it? Why now? What's the opportunity? Of course, you know, if you're just pitching a business that's selling umbrellas to a VC that said to its limited partners that we're going to invest in AI companies, then even if they think your umbrella company is amazing, then they don't get to do that anyway. So it has to fit with the fund's thesis. It has to, and sometimes you find that, which is like, sometimes a VC will have started a fund with a thesis of we're going to invest all in this one category, and then people call on that category, but they still made a commitment to the LPs, their limited partners, that they'd spend it on those kind of companies. And so they're forced to. It's sort of strange. You can't go back and say, we changed our minds. We're going to invest in the umbrella company. So yeah, important. What is it that you're doing? Why here? Why now? And does it match what investors are investing in? And finally, total addressable market, TAM. It might be an amazing idea, but is there an opportunity to scale this to $1 billion company? Is the market large enough? You know, it's something that VR struggles with. So I think everybody's quite excited about VR at some level, but there's also a concern that there's only 20 million headsets, whatever it is. So, you know, even if you made a real dent in that market, it's still not probably hard to make $1 billion company. Can you win enough of it? And back to that point that I said earlier, it's like, can this lead to a $1 billion company? Can it lead to a 25 times return? So it's got to, the maths have got to add up here. And even if the person you speak to in the VC is like, I love it, all about it, he's got to take it to the investment committee, which is sort of like a green light phase. So he has to then obviously convince his bosses that it's a good use of those funds. So that's probably the third thing. What's it like? So here's again something that maybe I poorly understood 10 years ago, and I can describe. I thought that I'd been board meetings where I'd have to, you know, speak to suits, and they come and, you know, look at my spreadsheets and tell me, you know, where I've dropped a decimal place or something. In my experience, I've never had I've had an official board meeting because somebody types up something every quarter, but I never actually. But they're just like, we tell them what we're doing, and I speak to them all the time because they're great. I really like them. You know, they have a load of, genuinely, like the support that we get from them. I think they're great. They're really nice humans, and they're super supportive. And it's not really suits that I feel like I have to get a lot of preparation for. So maybe that varies, but my experience of this is that we have catch-up calls every month where I tell them what's going on and ask their advice, but I haven't had a point where VC's ever told me, no, you should be doing this, not that. And there's this idea about value add VCs, and I think they sort of overplay this a little bit. Truthfully, often a company just wants the money, not looking for anything else. But equally, I've certainly had examples where people within VCs have helped me make decisions. So I'm not really looking for that support, but like introduction to other companies, and here's how we would have structured that. Have you thought about this? Can I help you hire someone? So that's there with some companies if you need it. Value add, they call that. And the last thing is, but you know, lots of events. So they're very keen. You know, it's in the VC's interest to have a success here. We're pointed the same direction. So I'll sort of whiz around the world and meet other people trying to do the same things as me, or people that could ultimately acquire us. And you know, so there's lots of sort of an event scene that's linked to venture capitalists' portfolio companies, of which we're one. How am I for time? Okay. I sort of, a few slides here. Reasons to use venture funding. I would say if you want to build $1 billion business, great. Sounds like you're a venture capital suited business. If you want to build a company to exit, as I said, the VC is not going to be interested in your company if you have no plans to ultimately sell the company. But if that is your plan, that's sort of a good fit for what VCs expect. And you want to maintain complete control. So I mentioned that we've probably all worked for publishers at one point, and you know, if they want the red thing to be blue, then the red thing gets to be blue. You know, it's you have a sort of a relationship with the publisher where you're implementing things that they'd like to see in the game at some level. And here, the VC, I've never known a VC to get involved in a creative or technical decision. So it very much feels like our company rather than make sort of, I don't know, building something for somebody else's company. So those or anything else? No. Okay. And also, reasons to avoid venture capitalist funding or investment equity funding, I suppose. First one is if you're games first, not business first. And I'm careful how I say this because great games create great businesses. Like if I didn't pay attention to making great games, then there's no way I'm going to make a great business. So they're not mutually exclusive, obviously. But I think a lot of people in the games industry, and it's fine, are here mostly to make great games that they want the world to see. And I think that's fine, that's great. But that's probably not right for venture capital. Well, it's definitely not right. And I really think you need to be thinking about it. You're running a business to make games. If you're, that's the kind of company that you want to be equity funded. A really big one, and you sort of know it already, and this is the one that VC won't tell you, is like, are you credible? I talked about the point earlier where they skip straight to the founders slides and they look at your little picture and where you said you worked before and what you did. And if you're not credible there, then the reality is, as much as you think you might be, venture funding might be suitable for you, they probably won't take that risk. So, I mean, it's not impossible, but I think the reality is that you probably have to have some degree of success outside of equity funding ahead of, before you're able to get equity funding. Yeah. And also if you want support from publishers. So again, I haven't done this for a while, but obviously publishers are there and they have a bunch of services that may be useful for you, like advice or QA or marketing or a ton of things that, at least in my experience, publishers offer. You don't get that with equity funding. Obviously, you're doing everything on your own. So again, might not be suitable in that respect. That's me. That's what I want to talk about. Some resources that I found really useful over time, and is this first one, Elite Game Developers, Joachim Akron, who runs an Angel Network, actually. He runs a podcast and a website with loads of templates and really useful stuff that I've used in my businesses. That's Elite Game Developers. FogDAO is a future of gaming DAO that's run by one of the investors at BigCraft. It's sort of a Discord group and a podcast that I found useful. Invest Games, you saw a report that they had created earlier, and that's all public and free. I can't vouch for its accuracy, but it's it's useful to see at some. Not all the deals are made public, so it's not likely to be accurate information, but it's accurate enough to be useful, I think. So again, that's something I found useful. And finally, this book here is a pretty easy, fun read about the best, sort of best practice of running startup companies in general. So that would be my recommendation. Happy to answer any questions. Is there a question over here?
Thank you very much, David. My question is about the angel investor process. You said you raised 60,000 from each of 10 angels. So could you just say a bit more about that? Like, how do you find them? How do you approach them? How much time does it take talking to them to convince them to give you that money?
Yeah. Again, just to be clear about what happened in our situation, I did a podcast talking about what I was going to be doing next, and I got a call from a VC that I knew, not a VC, an angel that I knew already. So, that's a bit of a what happened, but not necessarily useful if you don't know those people in the first place. And the reality is that I've been doing this for some time, so it's easier, and I do have connections with some of those people. That said, there are angel networks that you could look up on, like Joachim Akrin, the guy that runs Elite Game Developers. He runs a angel network, and by that I mean you can put a deal to him, and he will find people in his network that would like to invest in it. And there are other people. Nick Brown is a good guy that's based in the UK that does a lot of angel investment, and it's just very helpful in getting, even if he doesn't invest himself, about introducing UK games companies to angels. So I think it's sort of working through LinkedIn and poking people. And, you know, something to bear in mind is they're looking for deal flow. They're looking for opportunities. So you're not doing them a favor by saying, hey, could you have half an hour for me to talk about what I plan to do here? You know, I'm looking to get angel funding. It's so I think not sure I have a silver bullet. There's no sort of blog where you can look at everybody, but LinkedIn and networks where you have them.
Thanks.
Mm-hmm. There's a question over here.
So you were saying that who this is for, what kind of people this is for, and you mentioned like people who want to keep control. But I was thinking eventually they have to sell the company, no? So if they are gonna sell the company, I think my first thought it will be to a publisher. And then from the other perspective, the publisher would like someone who will stay with the company, no? Because the company they are buying, they are also buying the management, no? I mean, they were successful because of a reason. So how do you think that ambidexterity, you know, is kept? You know, you need someone who wants to get control, but eventually he will have to give that control to the publisher.
Yeah, I think you're saying that since a lot of things are trade sales where you sell to a publisher, maybe it's quite a likely path, then how do you sort of square that fact that you've got a founder that's maybe achieved what they wanted to? Why do they stay around? Is that sort of...
Well, it's more like from the publisher side, they want to buy the company, and they want to buy because it comes with that CEO or manager, no, which is very successful. But if that successful person is the kind of person who wants to keep control, then he may not want to sell to a publisher. So then you have into a cycle that you have the kind of person who got the investments from the venture capitalist because he wants to keep control, and eventually he's going to sell.
Right.
But you know, then
I see
the publisher.
So if you're the sort of person that likes to keep control, but now you're selling to a publisher and you're letting go of control, that is the process, right? So, you know, and I did this. Well, first of all, I think that the typical mechanism when I sold a previous company was you sell the company and then you're remunerated for hanging around for a while. So, you know, in my case, 3 years, I think. So there is that mechanism, but also like I've learned that like I'm here for a good time, not a long time. I'm not looking to take the company I'm not looking to leave it, but you know, I recognize that this is part of the process. I want to run it to a point where ultimately we can exit it. Good for anyone investors, good for me, good for the team. But that is the process, and I'm quite happy to let go at that point. At that point when an acquisition happens, it should be, it's not just about the exit from a financial point of view, but by becoming part of this bigger company, then is there an opportunity to sort of turbocharge what our plans are? And a good partnership should be, this is not just correct because this is a good payday for everybody involved. It's also like, great, we can now use this bigger company to take what we're doing to the next level. And I think that's how it should be thought about.
Thank you.
Thanks. Hi there.
Hey.
So just questions about the 15% magic number that you mentioned there, and all the various rounds that go through. Starting with the follow-on on the early slide that you had.
Yes.
So you've got your $1 million for 15%, but then you need a bit more. Does that mean another 15% investment, or is it part of the first?
Good question. Yeah. So it sounds like you'd be giving away 15% and then 30% and then 45 and 60. I think is your point, right?
Yeah, and same with later on as well. You've got 5 VCs. It's not 15% each.
Yeah. To be clear, when I said that, you know, in our case we have 5 VCs, that's 15% between them. I can't remember exactly what the number, but the main point to your question is that it's not 15% each time. It's what's called a dilution. So when there's a new investor, everybody shuffles down a little bit. So everybody has a little bit less to make room for a new investor that's taken 15% out. So technically what happens is new shares are issued, which means that you have the same quantity of shares, but of a larger overall amount. So, but yeah, technically what happens is people get diluted down, including the founding team.
So you're never giving away more than 15%, just everybody's share of that 15% gets a little bit smaller.
That's right. Yeah, everybody shuffles down a little bit, including the founding team. And, in our case, we set aside 20% of shares for for employees. So everybody gets diluted as we do further rounds of investment.
Great. Thank you.
What does that mean? 2 minutes. Okay.
If you do feel you have a credibility gap, which
Yes.
obviously seems to be a key thing,
Yeah.
Are there any strategies you can have around that, like advisory boards, that kind of thing? Do they wash at all, or are they just seen as fluff?
Good question. I'm going to say mostly fluff. I think there's lots of things you can do. Like one of the reasons why I'd recommend looking at these things, looking at these things, following Twitter accounts or venture capitalists and just understanding the language, like I'm talking confidently about how all this stuff works, about dilution, all of that gives sort of investors confidence. And I think it's good. Obviously, the less credible you are from a VC's point of view, more you have to compensate in other areas. So that could be like, what else? If you have a prototype or you have some KPI, you bootstrapped it and you said, look, we've got people here that are the retention or an engagement of this thing that we created. Look at it. How are you not sure? I might not be what you look for as a perfect CEO because I haven't done this before, but look at the product. So you have to sort of compensate in some other ways. But it is, I did 10 years of doing games for somebody else before I sort of had the credibility to say, it doesn't have to be that, but I mean, you might have to do a bit of that ahead of getting equity funding. But I would say that, their job is to invest money in games companies. So, and I would say that even if you don't get it, be just trying to be part of that process. The people that work in these venture capitalists, their job is to take calls and look at materials from potential investment opportunities. So I think getting in the habit of talking to those people is what they do and is a good use of time. Okay.
You've got time?
Sure.
Hi, David. Thanks for that. Building on that last point, if you were saying VCs will typically be looking for a credible team and be looking for someone who wants to exit, are angel investors the same as in on both those points?
Yeah, I mean, they're also looking for an exit. That's the only time they ever see any money. They're no different from other equity investors in that. And they are looking for an exit. But of course, things can be a bit more scrappy because the valuation isn't as high. So it's more like we're broadly heading this direction with these people. And it doesn't have to be quite as buttoned up as it would be before you go in front of a VC asking for a $26 million valuation.
Yeah. That's great. Thank you.
Good. Are we at time? Happy to answer questions. Thank you very much.